Today, we combine two of our favourite investing topics: how to invest in property and how to build this property portfolio using ETFs.
Investing in property through the stock market is done via REITs, real estate investment trusts. We've had a sniff around the internet and found 4 sweet REIT ETFs that we are happy to add to our own portfolios, being recent converts to the awesome power of REITs.
So why are REITs so worthy to hold in your portfolio? And which ones are we buying? Let's check it out.
Welcome to Unshackled.com, the investment and finance channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe.
And be sure to check out the offers page on Unshackled.com, where we are proud to bring you cashback offers, including this one from LoanPad, another way to invest in property via a top-rated peer-to-peer lending platform. You get £50 cash bonus when you open a new account and invest £1,000 for a year, and earn interest of 5% across the portfolio of secured property loans. Now, let's get into the video. Property ETFs. Property can be invested in through ETFs which own shares in REITs, which are in turn companies who own and manage commercial or residential properties. Basically, the proper name for a property ETF is a REIT ETF. If you'd like to invest in property or just want to diversify your portfolio, REIT ETFs are a great way to gain exposure to the UK and world real estate markets.
As of mid-2019, the 10-year average annual return for REIT ETFs had outperformed the S&P 500 index with an average annual return of 10%. This is an asset class you need in your portfolio.
Passive income assets. REITs are also widely used by investors interested in high dividend yields. REITs are required by law to pass on 90% of all profits as dividends, so ETFs that invest in REITs are by default passive income assets. Plus, the fact that most businesses will sign long-term leases on the commercial property they operate from makes REITs a consistent and reliable source of income.
How do property ETFs fit into a portfolio? A well-rounded ETF portfolio will cover all the main regions of the world. Their growth sectors such as tech and medical, various commodities and property, split between income and growth. As income assets spaced across multiple world regions, property ETFs help you achieve this balance with diversification and rock-bottom fees that you would expect from ETFs.
How to choose between REIT ETFs. REIT ETFs track REIT equity indices, so you profit from the returns of whole property markets. The international recognition of REITs has enabled the development of low-cost global property ETFs, giving you exposure to different countries' economies from within a property universe. This can be an interesting alternative to investing in a specific country's economy than through a normal ETF.
As you might expect, there are a lot of property ETFs to choose from, with complicated names that give little away about what they're actually doing. With that in mind, we've picked what we think are the best 4 that we would include in our own portfolios.
Number 1. iShares Developed Markets Property Yield ETF. This is where we would start, as the ETF tracks the FTSE Nareit Developed Dividend Plus Index. And as the name suggests, the index covers developed countries worldwide and has a focus on dividend returns, i.e. cash flow. It is, as you might expect from us, a distribution fund, meaning gains from rental profits are paid as dividends to you quarterly as an income rather than reinvested. We prefer this as we can then choose to reinvest our gains elsewhere.
This ETF gives you international exposure to the strong economies of the world that you need and the potential for strong cash flows. Winning! It does, however, have a high exposure to the US economy. The ongoing charges fee is 0.59%, pricey even for REIT ETFs, but the returns over the last 10 years have not disappointed, with a 9.13% annualised return. There is even a British pound hedge version which aims to reduce the impact of currency fluctuations. The ticker for this one is DPYG.
Number 2. iShares UK Property ETF. If you're confident about the long-term future of the UK property market, as we are, then the index that you'll want to track is the FTSE Nareit United Kingdom Index. This ETF does that nicely, with exposure to UK-listed REITs and is another cash-flowing distribution fund. Ongoing charges of 0.4%, which is standard for REIT ETFs, and annualised returns over the last 10 years have been, on average, 8.71%.
Number 3. SPDR FTSE EPRA Europe ex-UK Real Estate ETF. Those looking to Europe for a rebound from the stagnation of the last few years will probably want to track the FTSE Nareit Developed Europe ex-UK Index. This ETF tracks listed REITs in the developed European economies, excluding the UK. but it's the accumulation variety rather than distributing.
That's okay though, because ongoing charges on this one are tiny by REIT standards at only 0.3%. This fund has only been around since 2015, but the annualised returns so far have been an impressive 8.5%. We're hopeful that once Brexit is concluded, the economies of both Europe and the UK will kick up a gear following the gloom of recent years, so long term, this might be a good asset to hold.
Number 4, iShares Asia Property Yield ETF. Looking out at the mighty growth economies of Asia, this cheeky little number that's listed on the London Stock Exchange but tracks Asian property markets with a focus on income. The countries included are Japan 38%, Hong Kong 30%, Australia 17%, Singapore 14%, with 1% other, with proportional exposures to the currencies of those 4 countries.
Ongoing charges fees on this fund are again high at 0.59%, but has annualised returns over the last 10 years of 6.81% and is well placed to pick up future gains in this great region of the world.
Where's Vanguard? The REIT ETFs that we like most are primarily iShares ETFs, and kudos to them for giving us such a wide range of choice. It's a shame about the high fees though that come with REIT ETFs, which probably boils down to the fact that there isn't much competition. Unfortunately, our favourite provider, Vanguard UK, are not yet operating any REIT ETFs on the London Stock Exchange. But we live in hope that one day they will. A bit of competition from Vanguard should help to lower fees across the industry.
What percentage of your portfolio? REITs have unusually high dividends and special tax treatment of profits, are backed by solid physical assets, and have been shown to reduce a portfolio's overall volatility. The higher returns and focus on cash flow make REITs a solid part of any portfolio, but like any asset class, it should be a part of a wider portfolio of different asset classes.
Just because REITs have performed amazingly up until now doesn't mean they will do so in the future, but we hope they will. That's why we personally would not hold any more than 20% of our overall portfolio in REITs. It's a big investment world out there, and REIT ETFs should be a gem in the crown of any legendary global portfolio.
Question of the day. Do you hold any REIT assets? What do you think of them as an asset class? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.